if the Fed is slowing the runoff, on the margin, that's why I'm looking at bond yields falling right now. Is this welcome news for a Treasury market where every little bit that helps in terms of people keeping the treasuries that they have and not reducing their balance sheet more as the Fed's doing here, does that really help on the margin with interest rates as we watch the 10-year moving to the downside?
Well, very marginally. This actually wasn't unexpected. The problem, they've got multiple areas of uncertainty here, and one of them has to do with the debt ceiling. So they think there's going to be a debt ceiling agreement at some stage over the summer. When that happens, the Treasury is going to bounce up or increase its holdings of the Federal Reserve, which will cut reserves. It brings the idea of a problem in the Treasury market more, or in short-term interest rates more likely, and that's what they've been trying to avoid. They want to be sure that they don't have a repeat of what they had back in 2018, where they let reserves get down too low.
Yes.
Now they see a risk of that in the next few months, and that's why they're just backing off here. They just don't want to reduce that balance sheet too much and end up with a problem. So just trying to keep out of the way of trouble here in a very uncertain environment.
And David, I only want to harp on this because Steve just said there were some hawkish elements. So if people are wondering, well, why would that not translate to bond yields going up and so on and so forth? I mean, do you think that these moves on the balance sheet offset or mitigate that to some extent?
Maybe a little bit, but I think the truth is the economy, traders, consumers, businesses, we're all in wait-and-see mode here on what administration policies tend to turn out to be in the end on tariffs, on government cutbacks, on immigration, and on fiscal policy for 2026. I think the one thing I would sort of take issue with here is I actually think economic growth could be slower than 1.7% this year, fourth quarter over fourth quarter. We're seeing a good deal of weakness in the first quarter numbers, which isn't really reflected in their statement. So that's the one place I'd be a little bit different from the Fed on here. But I don't blame them for trying to be cautious here because they really have to wait to see what the other side of Washington does.
Yeah, and Steph, let's go back to this idea of the grammatical technical correction, right? The runoff, not the sell. And Steve, you jump in. But Steph, this seems to be maybe a bigger deal than the headlines might suggest. And I'm saying that because our friend Jeff Kilberg notes this is kind of a mini QE, quantitative easing injection. At least it appears that to him. Most of our viewers and listeners probably don't care that much about what the Federal Reserve does. They simply want their own borrowing costs, mortgage rates, auto rates, credit card rates, whatever it may be, to come down as well. How do you read this running off, not selling of treasuries?
Yeah, and that's been the case throughout, most of this QT period. Now they're just slowing down the pace of that, which makes sense, right? As David highlighted, there's concern around the debt ceiling that could create a lot of volatility within reserves. They're just trying to get ahead of it. This was a fairly modest move, and it was hinted in the minutes. So while this is slightly, a slight surprise, it was not overly surprising for the market. But this is the one difference versus what forecasters had effectively priced in, which was the change in growth, change in inflation, and expectation that they could stay pat on rates at this point because we don't really know the full effect of policy. April 2nd is going to be a really telling deadline in terms of what Trump's going to do from a tariff perspective.
Yeah, sorry, Jim. Let me just go very quickly through just kind of the people are just joining us here. Oh, my gosh, the Federal Reserve, they jump in. Here's, I think, how we're reading this. And again, Steve Leisman, please jump in if any of this is not correct. By the way, markets there are not moving or moving slightly higher. Maybe on this news we shall see. The Fed sees the economy expanding. Maybe 2 rate cuts seen this year. No real change in the job market the rest of the year. Maybe a slight, I think Steve Leisman said 0.1% drop in the jobless rate so far this year. Inflation maybe mildly higher as well. So, Jim, how do you read what the Federal Reserve just did?
I think this is very non-committal. The Fed is kicking the tires on the economy. Look, we have a couple of things in front of us, and I think it's very important to respect the timeline. We've got reciprocal tariffs coming up on April 2nd. We don't really know how that's going to go, but it's in front of us. Then you have first quarter earnings results that are going to come out. CEOs are not going to sing a positive tune about the first quarter, right? You're likely to see some basically some bad news from some of the CEOs, or at least talking that way. The next Fed meeting is May 7th, and I think that tees us up for a rate cut at the June 18th Fed meeting. So essentially, this is the first time the Fed is trying to make a decision as financial conditions are tightening, meaning that credit spreads are widening and the equity market has just gone through a 10% drawdown. So effectively, this is the first time the Fed is trying to decide, as markets are now starting to soften and weaken, what they ought to do. And in the past, you had a stronger equity market, tight credit spreads, and the Fed was trying to convince you that cutting interest rates was the right thing to do. Now, the markets are kind of siding that way, but they're not 100% sure how this is all going to play out. April data, the events of April, I can't underscore this enough, are going to be extremely important, and I think the tone is going to be changed by May 7th at the next meeting.